Mic check. Mic check. 1, 2, mic check. Good morning. How are you? That corner, I can't hear anyone. Good morning. This corner, good morning. Nyinyi ni kama hamjashiba breakfast, but it's okay, it's fine. So thank you all for making time to attend our national budget event here at Deloitte. So this is Marriott, we are not at Deloitte, but the event is Deloitte, please note. So a quick house rules. Number 1, the washrooms are to your left, or are to my left, to your right, okay? So once you get throughout this door, just go straight, alafu you'll take another left. The washrooms are there. And then just in case of a fire, please follow the neon green men running around. They will lead you to safety. So anywhere you see a neon green man running, that's a fire exit. Should be good to go from there. But hopefully the only fiery thing is going to be the insights and the discussions that we're going to have today. And so without further ado, I'd like to welcome our CEO, Anne Muraya, who's going to start the day and the event off with some opening remarks.
To you for our budget event today. I don't want to stand between all the really good knowledge that's going to come from our speakers and panelists, so I'll keep it really short. I just want to say I'm excited to have all of you here. I love the commentary that's been coming on the budget. It's exciting to see how we are all really, 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 really involved. And it's even ramped up from what has happened last year. So that participation is very interesting, and it makes it an even better event because everyone has had something about the budget before coming here, rather than many years ago where everyone was waiting to see what it is that we say. The year has been interesting with the ups and downs on the exchange rate, tightening monetary policy, resulting in high interest rates. And then, of course, lots of taxes and levies coming into our lives. Let me not steal the thunder of the people coming, but I guess that is continuing. But I guess, like I said, from the level of commentary, what I think we all need to keep doing is continue to be good stakeholders of Kenya Inc. You know, we are all in this. This is our country and we're all stakeholders. And our level of engagement in all of this brings benefit to us. So I ask you to be very engaged, to ask very many questions. Please make sure you ask the panelists really hard questions because they're really prepared. And enjoy this event, and hopefully you'll find it useful, enlightening, and with better insights on what's coming through on the budget. Thank you.
So good morning, ladies and gentlemen. So I found the theme for this budget a mouthful. Sustaining bottom-up economic transformation agenda fiscal consolidation, and investing in climate change mitigation and adaptation for improved livelihoods. Hopefully we can all remember one thing from there. And this is under the beta, which is what the Kenya Kwanza government is hinged on in terms of their plan. So I will take you through some economic highlights. I know we've all become economists. We've all felt what's happening from a microeconomic perspective. And we'll look at the global economy, then come to sub-Saharan Africa, then East Africa, and then the Kenyan economy, just to set the context in which this budget was set. So when we look at global GDP, it has experienced some strain. Since COVID, we've never really gotten back to what it was before, just because of the external shocks. So every year, I think last year when I was standing in front of people, I was talking about Russia, Ukraine. Today we have what's happening in Gaza. So every year there is a shock, since 2020. And this, of course, has had an impact on supply chain. China is not growing as fast as it was growing. They're having some challenges in the real estate sector there. And then, so Asia Pacific is looking like it will take part of the growth going forward, with a lot of people moving manufacturing to some of the other Asian countries, given what happened during the lockdown in China, which led to a lot of challenges for a number of people, just because of what was happening from the lockdown perspective and just supply chain shocks. When we look at cost of living, I don't think this is new for everyone, and it's a global issue. We are all suffering from inflation. We are all suffering from increased costs of doing business, and this is expected to continue just because of what's happening from a climate change perspective, as well as supply chain shocks given the various geopolitical crises around the world. We don't know what will happen in the US in November, whether Trump will come back, and what that will mean for the China-America love-hate relationship. Sub-Saharan Africa growth is expected to be higher than the global growth, coming in at about 3.8% in 2024, and then increasing to about 4% in 2025. However, Africa remains quite vulnerable to climate change, as well as supply chain shocks, and then obviously the debt levels in some of the sub-Saharan African countries. Case in point, what happened in Zambia and Ghana following just the inability to service their debt. So closer home to East Africa, Kenya's GDP growth looks fantastic, doesn't it? Yeah. From 5.6 in 2023 to 5% estimate for 2024, and 5.5% estimated for 2025. Obviously, most of our GDP growth is driven by infrastructure, so you will not feel it in your pocket. We were discussing at my table and saying the last time, for those who are our age, the last time we felt GDP in our pocket was when Kibaki was president. So it's been tough. It's tough for businesses going forward. Inflation continues to be high. At least Kenyan inflation is easing with the, when we look at what happened last year around, at least a good harvest, meaning that food inflation went down when fuel prices went down a bit. So that just led to a bit of easing of inflation, forecast to about 5.6 in 2025. Debt, of course, remains to be a challenge in East Africa, and more so for Kenya around the currency depreciation issue, which increased our debt service outflow. So what it means is that we expect that 2024 will be a tough year, because if you look at all the East African governments, they are all looking to borrow to fund the budget deficit, as per the budget that was read yesterday. So what do we expect to see in Kenya? So the GDP growth rate of 5% is supported by easing inflation, the reducing input prices just because of what's happening with our currency, and private consumption growth. However, given the Finance Bill 2024, there's going to be a bit of a challenge around private consumption because of just the increase in the various levies and taxes, though indirect in nature. Fred, I'm not stealing your thunder. They will have an impact on the pocket, which means then disposable income is expected to ease going forward, which means then the purchasing power of Kenyans is expected to decline. So the services sector is expected to take the biggest hit just simply because people will just spend on what's essential. Agriculture is expected to grow. However, we don't know what the impact of the recent floods will be on output. That will be known as we move towards the end of the year, and whether or not we are likely to experience any external shocks from a climate perspective because of just what's happening globally. So if there's a higher tax burden, depending on what is eventually passed as the Finance Act 2024, if climate change continues, then we expect that there'll be pressure for Kenya going forward. I've talked about inflation and how it has been mainly supported by lower food prices and of course the easing on fuel prices. Interesting that Tanzania is now going to start feeling the impact of the removal of subsidies on fuel, so maybe for us it's a good thing it came earlier. And so we expect the other East African countries, as much as we were not seeing depreciation in their currencies against the US dollar and other hard currencies, that is expected going forward. In terms of interest rates, those of you in the room who have loans, either personal or as businesses, you have received some notification from your bankers informing you that the interest rates will go up. And this then, of course, means that higher lending rates lead to reduced private borrowing and hence consumption. We find that disposable incomes are expected to decline going forward just because of the increase in interest rates. So there's going to be pressure there, both from a fiscal perspective and from an interest rate perspective. Okay. In as much as we talk about our environment our macroeconomic environment remaining broadly stable, this is on the back of us not defaulting on the Eurobond. If you remember last year, like now, we were all very anxious about what would happen come June 2024. So at least with the 1.5 recent borrowing that has helped us pay back part of the 2 billion Eurobond, that has led to a bit of stability and just certainty around what's happening in Kenya. So when we look at disposable income versus average spending, we see that Kenyans actually spend more than they earn, which means that if we continue with the Finance Bill 2024, there's going to be additional pressure going forward. I think I've talked a bit about the exchange rate and the debt. You can all see, and you all remember the Valentine's Day gift we received when the US dollar, that rate declined when the Kenya shilling strengthened against the US dollar. We don't know how long that will last, given some of the things that are happening. It is expected that maybe the dollar will close at about 145 by the end of this calendar year. So with the strengthening of the shilling, it means then our debt service costs are expected to go down, because what was happening is with the depreciation of the shilling, that meant that our debt service costs, especially for all our IMF and World Bank and other hard currency denominated loans, the cost went up just simply because our shilling depreciated. So on that backdrop, in terms of what's happening from a macro perspective, the tough situation we are in right now. I'll invite Fred to tell us more about what's happening on the tax front. Thank you.
Yeah, good morning, and thanks for joining us for our budget analysis event. So my work has been made easier over the last 2 years because, as Anne mentioned, a lot of us already know what's in the budget, what's in the finance bill. Most of you have become experts, so nowadays I don't have to do a lot of explanations. So if my presentation is brief, it's for that very reason, that most of you are already aware of what is happening. And maybe you've already calculated the impact of the finance bill on your pocket. I hope it's not too adverse. At least I can see you are still smiling this morning. So, but just to run you through a quick overview of what the budget looks like, especially from a revenue raising perspective. So we see that, as usual, every year there's an increase in the budget. So we always say that every year there's a record budget, and that's because obviously the government seeks to spend more, in terms of their priorities, and therefore they also seek to raise more taxes. So if you look at the trends, we see that over the last 5 or so years, the tax collection or the budget has been going up, and a lot of it still goes to, unfortunately, recurrent expenditure. So looking at FY 24-25, the recurrent expenditure is going actually to eat more than actually the projected tax collections. So a lot of the budget is going towards recurrent expenditure. Obviously, the counties are getting a share based on the formula that is provided in the Constitution. So this year they're going to get, or this coming year, they're going to get about 400 billion. And then the rest goes to development expenditure. So the interesting thing about this budget is that the government, kept the increase in the budget at a modest, 0.33%. But really the impact of that is that there'll be a cut in the development spending, which is usually what happens, because then the recurrent expenditure tends to run ahead of what is budgeted for. But then you get, the development expenditure either being cut back or being, moved forward to other years. So that's why you have a lot of, projects that are either stalled or you have pending bills, because then the government is not able to meet the full budgeted expenditure. Now, in terms of tax that is projected to be raised from the budget measures, so that second graph is very telling. So you can see that, in the last, let's say, before the Kenya Kwanza government, the budget measures were projected to raise anything between 37 billion to 50 billion. That's in terms of additional revenue. But in the last 2 years, that has gone up, to 200 billion. And now in FY 24-25, that will be around about 300 billion. So that tells you why a lot of you are feeling the pain, because through the budget measures or through the finance bill, the government is seeking to raise significantly more taxes than we've probably experienced before. And that explains the remark that, some people are saying that, did the finance bill come with the Kenya Kwanza government? A lot of people think that this finance bill was not there before until, and maybe the laughter in the room says some of you may agree with that sentiment. Then looking at tax collections, again, what we are seeing is that the Revenue Authority tends to run behind in terms of projected collections. So in the current, financial year, which is ending this month, we don't have the current numbers, but as of Q3, you can see that, they were 14% behind on what was budgeted last year. So effectively, what we are saying is that you put in a budget and saying we are going to collect, let's say 2.4 trillion shillings for this current financial year, but you end up collecting maybe 2.2 trillion shillings, So they'll be running about 200 to 300 billion behind what was budgeted in the current financial year. So what does that tell you? That even in this budget, FY 24-25, although we are projecting to collect about 2.7 trillion shillings in taxes, that is really an ambitious target because it represents, almost a 20% growth from the actual collections that will be realized this year. And yet we are running behind this year. So it tells you that even, in the new financial year, meeting those revenue targets will not be easy. And that explains why a lot of us are now scared of the Revenue Authority, because the Revenue Authority also has to go overboard, in order to try and meet their targets, some of which could be, unrealistic given if the past is anything to go by. Now, one of the interesting conversations that has, come up of late is what we call the tax to GDP ratio. And you've heard, our president say that we need to up our tax to GDP ratio to at least 20%. He said he needs to do that within his, first term. So then we ask ourselves, what is it about tax to GDP, and so we did a little presentation here just to show you the tax to GDP ratio of some select countries. And you can see that other than South Africa, which is at 27%, and maybe Morocco also at 27%, Kenya is actually not doing too badly. And also considering the fact that some of the other countries you see there are resource rich, so it shows that for the rest, for Kenya really at 15% is not that bad, But one of the interesting things is, you need to ask yourself what contributes to what one would consider a low tax to GDP ratio. So it's not necessarily a problem that we are not paying, enough taxes or we are not being taxed enough. There are many other factors, the key one being the structure of the economy. Obviously, when we are, a lot of our economy is reliant on the informal sector, which contributes very little to taxation, and that's because of the income levels, nothing to do with the taxpayers themselves. And also, agriculture is a key component of our economy, but we do know that the contribution of agriculture in terms of taxes is quite low. Partly could be because a lot of it is subsistence farming, production of primary commodities. We don't do a lot of value addition. So all that contributes to a low tax to GDP ratio. So my takeaway is that if the government is seeking to raise the tax to GDP ratio to at least 20%, that means they're going to be coming back to the same taxpayers to raise that money, and a 5% increment is not a small amount. It's over 1 trillion shillings in extra taxes. So you can project what you are going to be required to pay over the next 2 or 3 years if the government wants to collect an extra 1 trillion shillings from the existing taxpayers. So that is going to be a common theme of the Kenya Kwanza regime. If they're to stick to their plan, it means that every year we are probably going to be feeling a little more pinch in terms of the taxes that we are required to pay. So I hope to be the bearer of good news, but unfortunately, I can't deviate from what the government is planning. Now, just to highlight some of the tax measures, and this is not everything because, like I said, most of us have been sensitized to the tax measures, and we do have our publication, which will contain the detailed, tax measures. So feel free to look at our publication. But I thought we should highlight some of the key ones. And I wanted to start with one of the most controversial ones. So I'm sure most of you either drove in this morning, or maybe you took an Uber. You know, I don't know which means you used. Hopefully no one used a helicopter to come here. But one of the policy makers recommended that probably it's not a very good idea for you to drive here, that instead you should have walked, you know. And so because you opted to drive, you know, the government saw it fit to ensure that you contribute more to revenue collection by proposing a motor vehicle circulation tax of 2.5% of the value of the vehicles, you know, and that is debatable in terms of which value will be used, but subject to a floor of 5,000 shillings or an upper ceiling of 100,000 shillings. Now, interestingly, when you know, the Treasury, you know, CS appeared in the media yesterday, he did say that there'll be no upper ceiling, so it's likely to be much higher for those of us whose vehicles are worth, you know, much more, and I wouldn't say who. But really, the question that we're asking ourselves is this a wealth tax? Is it an income tax? Or what exactly it is, you know? And if you watch the media, if the government was not able to explain it, I'm not sure I'm going to do a better job at explaining the government's own policy that they are not able to explain. But, you know, what we would like to observe is that ideally, you know, income tax should be a tax on income, you know, just as the name suggests. And income is defined to be gains or profits, you know, for those of us who do taxation. So one of the things is that it appears to be misplaced in terms of having a motor vehicle tax that is in the Income Tax Act that is subject to, I mean, that is taxed on the value of a vehicle or the value of an asset, because ideally if it's an income tax, it would be either on the income that you produce from the asset or the appreciation in the value of an asset, like capital gains tax, for example, when you dispose of an asset that has, you know, appreciated in value. So it's not quite clear whether this is a wealth tax or an income tax or any other form of tax. But as you know, we now have new taxes coming on board, so this is one of those. The impact would most likely be adverse, especially to the insurance sector, because based on the projection, the government is projecting to collect at least 58 billion shillings from motor vehicle tax. Now, when I check, that's almost similar to the amount of, to the gross premiums that the insurance industry collects on motor vehicles. So effectively, it means it will double your insurance premium, you know, if you look at it that way. So that will be quite significant. A lot of you rely on insurance premium financing. So maybe the bankers are going to tell us whether they are going to offer us better financing for insurance premiums now that we have to pay more. But the other illustration that we wanted to put across there, just to give you a view of why we think this measure is probably not appropriate, is that motor vehicles are heavily taxed. So if you import a vehicle, and I'm sure many of you may have bought an imported vehicle, so the way I put it to a layman is that if you buy yourself a vehicle, you have to buy the government a similar vehicle, because the taxes on your imported vehicle are actually the same as the value of the car that you import, and that illustration depicts that. But in addition to that, when you fuel, which is what really you pay on the use of the motor vehicle, the taxes on fuel are up to 74%, and as if this is not enough, you might have heard the Minister or the CS for Transport and Infrastructure saying that they want to increase the levies on petroleum products. So from the 74%, we don't know whether it will go to 100%, but this just gives you a picture of the heavy taxation of motor vehicles. So we think that this measure on the 2.5% motor vehicle circulation tax may not be appropriate. It's placing a heavy burden on a small segment of taxpayers. And remember, one of the principles of taxation is that we need to spread the burden fairly across a larger population. Now, the other tax increase that we are seeing is what we call freight tax. So this mostly affects non-residents, you know, ship operators, aircraft operators who come into the country to pick up cargo or passengers. They've been required to pay tax at 2.5% on their gross proceeds, but that has gone up now to 3%, though there is a welcome clarification that if they are covered by treaties, then that may not affect them. But those who are not covered by treaties will be required to pay more tax. So you are likely to see maybe an increment in your freight bills if you are involved in importation of goods, for example. On the capital gains tax front, there is some exemption for property transfers carried out by licensed special economic zone entities. I guess this is to promote, the SEZ concept, which is one way of attracting, investors to come and set up in these zones. And then Kenya is also trying to set up a financial hub through the Nairobi International Finance Center. So any investment that is certified under the Nairobi International Finance Center will be exempt from, will be subject to a reduced CGT rate of 5%, upon disposal. So those are some positive, changes there. A lot of us have benefited from the high interest rates that are offered by the government. So most of us, including institutions, are investing in bonds, including infrastructure bonds, which have had the added tax benefit of being, exempt. But now the government wants a share of the interest that you get. So infrastructure bonds issued from 30th June this year will no longer be tax exempt, but rather would be subject to withholding tax. That's on the interest at 5% for residents and 15% for non-residents. So it remains to be seen whether that would impact the attractiveness of these infrastructure bonds. But it's important to note that that rate is still lower than the typical rate that applies to other interests. Now, one major move that is, we believe, is aimed at maybe capturing more taxpayers into the net is the introduction of withholding tax on goods supplied to public entities, 3% for residents and 5% for non-residents. Now, while this is a good move, I guess we all know the issues around the delayed payments from public institutions, especially government institutions. So this maybe means that those who are supplying government institutions may have to contend with the reduced cash flows, and potentially some of these suppliers will then seek to pass on that cost to the government through adjustments in their pricing, and this could then make goods supplied to public entities to be more expensive. So that's likely to be the impact. The other impact is that if your products have low margins, then that would put you in a tax refundable position, and again your cash flow will be tied with the revenue authority. So that's quite significant for some suppliers. Now, on the digital front, as you are aware, the government has been making a deliberate effort to get more from the digital economy, which is picking up not just in Kenya but globally. And a few years back, we had something called digital services tax that was introduced on basically transactions carried out through digital platforms. Now, there was a lot of backlash on this, especially from our American friends, because America views DST to be targeted, especially at American multinationals. You know who they are, the Googles of this world and so forth. So because of the discussions that are going on at the global level around the OECD and the inclusive framework and the BEPS framework, there was some sort of consensus that countries should do away with the digital services tax because of what is being proposed under what we call Pillar 1 and Pillar 2, which I won't bore you with, So Kenya seems to have complied with that and done away with digital services tax, but in its place we've introduced what we call significant economic presence tax. Basically what this means in a nutshell is that, in the old days we used to tax you based on your physical presence in a country, so if you set up an office, if you brought your personnel to work in country, then that would be considered to be taxable presence. But with digital economy, you can establish a presence even without a physical presence. So it means that, for example, if you are, these social media platforms, for example, you don't need to have a physical presence in Kenya, but you could still generate revenue, say from your users who are present in Kenya. So through that, then that is what we are, calling significant economic presence. Although in the finance bill, the parameters for establishing what this presence is has not been defined. But what we see in other markets like, India, for example, which has this form of tax, is that it's either based on your number of users, on the revenue that you generate from, Kenya in this particular case, or from a particular country. So those would be deemed to be, establishing your economic presence, and then you'd be subject to tax at 6% of your gross turnover arising from the country. The other tax that has been introduced is withholding tax, which is now a requirement for, operators of digital marketplaces. And these are typically the digital platforms that we use, for example, for ride hailing, for delivery services, for providing professional services, even rental services like your Airbnb. So basically what the government is doing is now appointing the operators of these digital platforms to be withholding tax agents, meaning that if they pay you, for example, if you are one of those who, for example, offer services through a digital platform, then whoever is paying you will be required to withhold tax. Now, this could be a challenge for non-residents who do not have a presence in Kenya, because then they may be required to register in order to be able to account for this tax. So we are waiting to see what rules will be put in place to facilitate them to be able to register and comply. Still on the income tax front, there's a lot of developments on the global landscape. And one of the major developments is that there's been a move towards what we call a global minimum tax, which is basically a requirement that multinationals should pay at least an effective tax rate of 15% in all the countries in which they operate. Now, failing which, individual countries are allowed to come up with other measures to be able to collect additional tax from these multinationals. And one of those measures is what we call a domestic minimum top-up tax. So this is basically a tax that, for example, Kenya can impose on a multinational if it establishes that this multinational has an effective tax rate that is lower than 15%. And this applies only to the very large multinationals with a consolidated group turnover of at least 750 million euros, which is round about what, is that about 100 billion Kenya shillings? So it applies to a limited number of multinationals, but those multinationals would have to be careful around what the effective tax rate is in all the countries that they operate. Now on the withholding tax front, especially as regards software, there's been a definition change, and now all software-related payments will be subject to withholding tax. We think this is inappropriate. It was really a reaction to some of the losses that the Revenue Authority has suffered on the cases that they've had on, withholding tax on software, because there's a global definition of what constitutes royalty payments, and Kenya is seeking to be a little different in order to collect more tax. But what happens is a lot of these contracts are net of tax arrangements. So if you impose withholding tax, the supplier is likely to pass on the cost to you as the entity that is consuming the software. So it only goes to add to your cost of business. Now on the transfer pricing front, a welcome development. You can enter into advanced pricing agreements with the Revenue Authority, which basically defines, what your arm's length pricing will be in a negotiated arrangement, so to say, with the Revenue Authority. So this is a positive measure because it can then help you to manage your transfer pricing risk. However, experience from the countries in the region which have this framework is that the Revenue Authority is not adequately prepared to implement this. So you really struggle to get them to sign up any agreement with you because they haven't upskilled their teams to be able to negotiate this agreement. So it remains to be seen whether this will be a success in Kenya or whether it will take time to realize the benefits of this measure. Now, on the personal income tax front, last year, most of us would have felt the impact of the, increased marginal tax rates. That's 32% and 35%. So this year, luckily, we were spared another increase in the personal income tax rate. And then to give you some, relief, even if limited, a number of deductions have been introduced. So the contributions that you pay to the Social Health Insurance Fund, which is kicking in next month, and the Affordable Housing Levy, those will now be deductible against your taxable income. The contributions to Post-Medical Retirement Fund, which is a new concept that the government is trying to promote so that you're able to take up insurance for your medical after retirement. That will also be deductible, subject to a limit of 10,000 shillings. Your contributions to your normal pension scheme, the limit has been 20,000 shillings per month. That has been increased to 30,000 shillings per month. And your deductions, if you are making use of a mortgage for your primary residence, you'll now be able to claim a deduction of 360,000 shillings, up from 300,000 shillings per annum. And then on the individual taxation still, for those of you who make use of per diems, now you'll be allowed up to 5% of your monthly income as non-taxable per diem. So this will benefit the high-income earners more than the low-income earners. So there is a question of whether it's equitable or not, but we think this is a positive move. For those who are provided by company meals, the tax-free threshold goes up to 60,000, up from 48,000 shillings. Still a little low, but at least some modest increment there. Other non-taxable benefits, the threshold also goes up from 36,000 to 38,000 shillings per annum. Now, another interesting one which was sneaked in here, and I say sneaked in because it benefits the policymakers, is that amounts paid to public officers as reimbursements for expenditure incurred in performing their duties will not be taxable, notwithstanding the ownership of assets. So, for example, if and we think this is rather gray or vague. So, for example, if a public officer is given a car and they say they're using it for performing their duties, and maybe they take ownership of that car, it will not be taxable. Yet we know that for the rest of us, if you are given, for example, a company car, then that is deemed to be a taxable benefit. So this is rather questionable, and we hope it will not result into misuse of public resources. And then for those of us who are planning for retirement, no pressure. There'll be tax exemption on payments out of a retirement benefit scheme, provided that you've attained the retirement age according to the scheme rules, or you've been contributing to the scheme for at least 20 years. So this is a welcome relief because it will then, give more income to retirees, which is a good thing. On the VAT front, some few but significant changes. I think, you've all seen that the VAT threshold has been debatable, especially with the rules around e-teams, which has been introduced. So in the finance bill, there's a proposal to increase the VAT registration threshold from 5 million to 8 million shillings. So this is really supposed to relieve the small businesses from the VAT compliance burden. However, we are saying that with e-teams being introduced and being applied to all businesses regardless of your threshold, then there is still that added compliance burden even if you do not fall within the VAT registration threshold. So it may not be quite a significant benefit given the requirements under e-teams. Another positive measure that we are seeing is the reintroduction of the exemption from VAT in relation to transfers of business as a going concern. So this is really critical, especially for business reorganizations, M&A, where businesses either merge or go through disposals and acquisitions. It's been a major hindrance to these business transactions because the VAT cost can be quite significant. So this exemption is much, much welcome. And we believe it will facilitate more business transactions. Now, for those in the financial services sector, this is something that is quite significant. So financial services have been exempt from VAT, and this is more or less a global practice. But Kenya is now proposing to remove this exemption and apply VAT on quite a number of financial services which are listed here, including the issue of credit and debit cards, money transfer services, foreign exchange transactions. Now, some of this is quite vague because we don't know what the VAT will be applied on, whether it's the fee or the commission charged by the financial institution, or whether it's the margin or spread, for example, on the forex trading, which can be quite significant. If you are talking about the assignment of debt, for example, is it on the discount that is being, charged on that factoring transaction, or what exactly will the VAT be applicable on? So we believe this requires additional guidelines, but the financial services sector, they've made very strong representations to the effect that we should maintain the status quo in terms of the exemption of financial services because of the benefit to the economy in terms of facilitating financial inclusion, the ease of doing business, because financial intermediation is quite important to the economy. So this came as a surprise, but we believe it's part of government effort just to try and collect more tax revenue. But we hope they'll consider the implications, even as the finance bill goes through Parliament. And then this is one of the other trends that we are seeing over the last few years. That is, the government is reducing the number of exempt or zero-rated transactions, and this is likely to continue. So, we believe it's something that the minister actually categorically stated in his speech yesterday, that there'll be much, much less exemptions. Actually, the exempt items, he said, will be moved to the standard rated, schedule, and those that are zero rated will be moved maybe to exempt, except for export. So going forward, it's probably only exports that will be zero rated. The rest will be either exempt to a limited extent or standard rated. So this is really in a bid to raise more government revenue, because in the government's own estimates, they are losing up to well over 300 billion shillings in terms of VAT refunds, and they want to minimize VAT refunds. So from a cost of goods perspective, some of this may have an impact in terms of increasing the cost of goods. However, we believe for some of them which were exempt, if they are now standard rated and the manufacturers are able to claim the input VAT, maybe the impact may not be as significant. So it depends on particular products, but some of them may attract a lot of public attention. So for those of us who eat bread every morning, the advice is that you should look for alternative sources of your carbohydrates and try and look after your health, you know. And that advice did not come from me. Now, on the excise duty front, so just to mention, excise duty is one of those taxes which the government is really taking a lot of interest in. So traditionally, we used to call this sin tax, you know, and it was targeted at alcoholic beverages, you know, cigarettes and the like, you know, probably betting, you know, which has come up of late. But now we see that a lot more products, you know, are being put within the, you know, excise, you know, within the scope of excise duty. And that is likely to continue. Actually, if you look at the budgeted amount for excise duty for FY 24-25 is well over around 450 billion shillings, up from around, you know, around 240 billion shillings. So the government is expecting at least a 50% increase in excise duty collections, which is quite significant. And that explains some of these measures around the increases in excise duty rates and the adjustments in the, you know, in the manner of computation of excise duty. For alcoholic beverages, for example, instead of having specific rates, now that will be based on the alcoholic beverage content, and some of our panelists may elaborate on that as we go through the panel discussion. But basically that means some of the products will be cheaper, but others will be more expensive depending on the alcoholic content. There's been a controversial move to remove relief from excise duty incurred on raw materials. This is likely to make manufactured products more expensive because it essentially amounts to double taxation, because previously what would happen is that you claim relief on the excise duty that you incur on your raw materials, so that should not be a cost to the manufacturer. But with this measure, it means it will be an added cost, or, you know, to the manufacturer. So I've talked about some of the changes to excise duty rates, so I won't go through all of them. Some interesting ones, for example, the government is removing excise duty on petrol engine motorcycles and introducing excise duty on imported electric motorcycles, which is rather contrary to the, you know, climate credentials of our government. So I don't know whether the policies are talking to each other, but that's something that should be looked at. And then you have some excise duty on vegetable oil. So again, I think there's a focus on health, so maybe we'll be eating boiled foods going forward. Now, another controversial introduction here is what we refer to as the eco-levy, which has been introduced on a myriad of products, including plastic packaging. So plastic will become much more expensive. I think the important thing to note here is that because plastic will then be used as packaging for finished products, it means the cost of those finished products will likely go up due to the increased cost of packaging. So that's something quite detrimental to the you know, competitiveness of some of the businesses that are affected. Now, digital transactions, again, like I said, these have become a target for government. So now there'll be excise duty on digital services applied by non-residents through what we call digital platforms. So the bill does not define specifically which you know, services, so it could be quite wide in terms of what excise duty will apply on. But this means that any service that is supplied through a digital platform, so for example, if you download, you know, movies, or if you download books from a digital platform, then the provider is supposed to charge you excise duty on that. So this will be quite interesting because, like I said, some of those providers are not present in Kenya, so they would be required to register in order to be able to account for this excise duty or to appoint agents to do it on their behalf. Now, another rather unwelcome move is the increase of excise duty rates on telephone and internet data services, money transfer services, and then betting, gaming, and lottery, which we've seen has been, targeted in the recent past. And then introduction of excise duty on advertisement through digital platforms, like social media at 15%. So excise duty, the rates are either going up or more products are being targeted for excise duty. So it looks like this is one of the favorite measures for government to raise additional revenue. So be careful, because it seems if your industry prospers, then you should be, you'll be called upon to accommodate more excise duty. And in conclusion, a few other changes. So IDF, the rate has gone up from 2.5 to 3%. And this is one that is interesting because last year the rate went down and now it has gone up. So we are saying, what has the government discovered in 1 year to keep changing the rate so frequently? So this is one of those that calls into question the stability of our tax policy. And of course, it will affect, the cost of goods that are imported. And then eco-levy has been introduced on quite a number of products in a bid to, quote unquote, protect the environment. Now, we feel that probably what the government should be looking at is other measures to encourage responsible waste disposal. We know a lot of companies are already taking proactive steps in terms of their environmental footprint. There are measures that have been put in place in terms of extended producer responsibility to be able to take care of the environment. So we think the government should take into account these other measures or incentives that would encourage responsible management of waste or reduction of environmental impact, as opposed to just imposing taxes on particular products, which taxes may not actually be used for the intended purposes in terms of environmental protection. This will most likely go into the state coffers and then will be utilized for recurrent expenditure that may have nothing to do with environmental protection. So this is something that calls for a lot of rethinking. And we hope that the appropriate measures will be considered. Taxpayers have made a lot of representation, so we do hope the policymakers will consider that. And finally, on the administrative front, one of the key changes here is KRA is seeking to get more and more information on taxpayers. They've been attempting this for a number of years, so it's not necessarily new. It's just that the law has been protecting the privacy of personal information, but now they want to go around that by amending the law to exempt them from the data protection regulations. We think this will be quite risky, knowing the kind of information that they'll be seeking to access, which is quite sensitive, and it could be abused because sometimes we see that the KRA goes after information that may not necessarily be relevant to what you think they're trying to achieve. So we think this is one measure that should be carefully reconsidered to ensure that it's not abused and to protect taxpayer confidentiality. They do have other means that they can use to get information that is relevant for them to perform their role. So we don't think it should go this far. And also it would open up the window for other government agencies to continue, seeking to get into your private space. And then for tax refunds, there is now a limited window to apply for VAT refunds, which is 6 months. We believe this is not appropriate because it's really, you shouldn't lose your right to your property because that's your property just because of technicality. Because some of this arises because of either adjustments to your tax computations, your filings, or other information that becomes available to you after a lapse of a certain period. So if the period is too limited, then you'd end up losing money that would otherwise be yours that you could be putting into good use in your business. So we think this should be looked at, and it will be unfair to the taxpayers. So yeah, so these are some of the key tax changes. As I mentioned, this is not everything. There are many other changes, but you'll find those in our publication. But we wanted to highlight some of the key ones and the impact that will will have on you as a taxpayer or on your business. But now we'll have an opportunity together with the panel to just delve deeper into some of these measures. And so our moderator, feel free to take over. Thank you.
All right. Those have been a lot of insights. When Fred was saying there are some people who only heard about the finance bill in the Kenya Kwanza government, I was in that WhatsApp group. And I genuinely, I think before, because it wasn't hurting my pocket, and also maybe being of a younger generation, then only my parents could feel the crunch. But now that it's also affecting me, I'm an activist in that, right? What is this finance bill? What is it saying? And a fun fact is also, because Gen Zs, when we are affected by a thing, we try to look for the easiest and most efficient solution. So there's actually a chat GPT for the finance bill that's been created. It's been fed with all the information about the finance bill 2024. So all you need to do is just ask it, hi, ChatGPT, what are the main insights from this finance bill? Will I be able to make it in this economy? Okay, so as we're setting up for the panel discussion, for the next session, I just want to go through a couple of things. One, as usual, house rules. The washrooms have not shifted. The fire exits have not shifted either. They are where they were, as I announced. And also, having been given the said economic and tax context, to the national budget, we'll be moving on to what I hope will be a very spirited conversation between the panelists. And this conversation will be moderated by IMF Journalism Fellow and the host of the Business Redefined and CFO Chat, Julian Samboko. Karibu sana, Julian.
Thank you so much, Ivy. Oh, we need some moderation there. Good morning, everyone. You know, we've been through some rigors here. So yes, my name is Julian Samboko, and I work with the Nation Media Group, covering largely public finance, capital markets, and sovereign debt. So this kind of stuff is the stuff that I really enjoy. And I was joking with Fred as I got here that one Kenyan stopped me on the road and told me, your Twitter handle is the biggest stress generator in my household. We look at it and we are so angry, and we want you to help us. So I'm like, how do I help you if I don't give you the information? So my panelists will be helping me navigate a number of issues on the scene setting which has just been done. And let me take this opportunity to invite back on stage Mr. Fred Omondi. Karibu sana. Let's appreciate him as he makes his way back here. The Group Chief Finance Officer of EABL, Rispa Genga Ohaga. Senior Advisor, Global Lead Industry and Commerce at Tony Blair Institute for Global Change, Phyllis Wakiaga. The Acting Chief Executive Officer of the Kenya Bankers Association, Raymond, karibu sana. And finally, Professor, Faculty of Business and Management Sciences at the University of Nairobi, Professor XN Iraki. Karibu sana. Oh, looks like I'll be on this end. Oh no, not in the middle. Yes, Friends, I conduct my panels very differently. As opposed to listening throughout and then we invite questions, I'll do a couple of questions with the panel, then I invite some interaction with you. So please, as you listen in, be ready to fire your questions. Let me start with Fred, since you're just from stage. Fred, yesterday I was listening to the Treasury Cabinet Secretary, and one thing that emerged from his remarks was we are looking at almost a complete overhaul of the first and second schedules of the VAT Act. And the question which popped up in my mind is, will this be done progressively across various finance bills, or is this something which he was prompting us that, by the way, as you expect the report from the National Assembly Finance and Planning Committee, please anticipate this change? Fred.
Yeah, so this is actually not necessarily new. Remember, we had a new VAT Act, now not so new, VAT Act 2013, and part of the reason why there was a new act was that the government wanted to really, radically change, the structure of VAT, and the aim was to achieve a few things. One was to harmonize the rates, maybe eliminate many rates, although we still ended up with some special rates, and then to eliminate as many exemptions and zero rating as possible in order to collect more tax. So when we started with the VAT Act 2013, the first and second schedule were actually quite, quite small or limited. But then over time, the list of exempt or zero-rated items kept increasing. And year in, year out, there are always changes. Items move from zero rate to exempt and back. So you are not quite clear whether the government has predictable or a consistent policy when it comes to zero rating or exemption. But what we see is that now there's a lot of pressure for government to minimize what they call tax expenditure. Tax expenditure is basically the revenue that the government forgoes, when they give any benefit or incentive to taxpayers. So with that pressure coming, and it's public knowledge, so this is not a secret, we are under an IMF program, and IMF is really at the forefront of driving the elimination of tax incentives, both from a VAT as well as an income tax perspective. So that is something we are likely to see continue as a trend. Obviously, the government has to balance that with what is really, favorable for the economy. For example, exports, it's best practice that they're zero-rated to make them competitive. Then there would be certain essential products or services that the government needs to look at. And I think that's where the challenge comes, because it's probably done in a haphazard manner, so that's why there are a lot of constant changes. But if there was a thorough examination and determination of what really qualifies for exemption and zero rating, and then we keep that stable over a reasonable period of time, then we wouldn't see all these changes coming in every year, year in, year out, which makes it very hard to predict where the policy, is headed.
Thank you for that, Fred. Very quickly, just to stay with you, now that you've mentioned how we have been flip-flopping around zero-rated and exempt, we have now seen sessional paper number 2 of 2023 with national tax policy. Do you have a measure of confidence around how we'll navigate this going forward from a predictability standpoint?
So first, of course, is to acknowledge that it's a good thing to have a national tax policies, and as practitioners, we were at the forefront of calling for that. So it's good that that has been done, but that's only as good as the paper it's written on if it's not implemented properly. So looking at some of the numbers that we talked about and the intention of the government to raise revenue significantly over the next few years, I have my doubts that they'll stick to what they've said in the national tax policy, So I expect that even next year you'll see quite a number of changes. So in the next few years, you'll probably see a few changes, maybe except the election year. I hope I'm correct on that. So the national tax policy is a good statement of intention, but really how it's actually translated into policy choices in terms of what we tax, how we tax, the rates at which we tax, that's what really determines whether the document is live, whether it's a good, whether it translates into good practice. So having a document is one thing, how you implement it is another thing.
Thank you. Constructive skepticism there. Thank you so much, Fred. Pivoting now to RISPA, and RISPA, the last time you and I sat together, we had an interview which caused a storm in this country around Section 36 of the Excise Duty Act. So looking at the budget that was tabled, the statement yesterday, and the finance bill, this country speaks about placing manufacturing front and center. The target is 15% of GDP. Are you persuaded that this budget actually speaks to that intent?
At the risk of causing another storm, I think, let me just first by saying there are some good things in the budget, but there are some extremely challenging things from a manufacturing perspective. On the good side, certainly issues like the advance agreements on the transfer pricing side is a positive thing. Also, measures to improve disposable income are definitely very welcome, because if an economy grows from spending, and if people can't spend, then the economy shrinks. On the positive as well is things like finally recognizing the challenges on the beer industry, which has been declining at 2% CAGR every single year on account of increased taxes, and finally doing something about that and bringing us closer in line with other markets. The downside, which is very, very major for manufacturing, is the deletion of Section 14 of the Excise Duty Act. That's extremely detrimental. When we quantify it, the net effect of, if I'm producing a bottle of Chrome, which my Gen Zs might recognize, and I'll sell it at 290 shillings, right now the proposed excise increase is 80%, which means I will price it at 400 shillings. If Section 14 is deleted, I will price it at 770 shillings. In Uganda, the same bottle will cost 300 shillings. In Tanzania, it will cost 150 shillings. And if I import a Scotch whiskey from Scotland, it will cost 570 shillings. Now, that tells you that we are maybe promoting imports as opposed to local manufacturing.
Wow, that's quite spot on in terms of the perspective of what this means. Raymond, glad to have you here. Raymond, I have had a baptism of fire. Financial services, quite topical, and that's where I'd like us to start from. What would this mean for the financial services sector? What would this mean for ordinary Kenyans?
Yeah, thank you. I look at it on this angle that Kenya as an economy, and even the Cabinet Secretary mentioned it yesterday, in that close to 83% of the economy is actually run by small micro businesses. And then again, this is a sector which employs closer to 17 million Kenyans, driven through small micro businesses, both at individual level and even small businesses. And then the other challenge again is we need to move this economy from the informality to formal economy, because that's the only way we'll be able to expand our tax bracket, and then also be able to ensure that we're creating employment and we are generating a population which can actually be able to consume most of our goods that our big manufacturers can actually be able to do. Now, moving this conversation to the VAT, it complicates the ecosystem, because it will now even push the little people who are within the informal sector deep into the informality. Because what you're speaking here, Julian, is the fact that currently for financial services, we only have excise duty on the financial charges. So when you're transacting, you're paying a bill, either you're in a supermarket or you're paying school fees, or you're even doing a transaction where you're paying a hospital. So you pay the 10,000 to the hospital, so the money moves from your account to the hospital's account. The bank charges you a transaction fee of 100 shillings. So currently, we only pay 115. Now, that excise duty is increasing to 20, it comes to 120. And then now, how the calculation happens are that the VAT is now applied on top of the 120, so it moves to 139.2. That's why we are calling it movement from 115 to 140. That's very significant, 25 shillings move. So what we have actually been pleading with government is that instead of pushing people into the informality, because we've made payments and transactions quite expensive within the formal ecosystem, let us in fact even look at being able to reduce the rates. We bring in more people into the ecosystem and we can actually be able to push this forward. I was privileged to have this conversation with the president on Wednesday, and in a way he was getting to understand that challenge, that unlike other places, like even manufacturing, because for manufacturing you're saying even if our goods are expensive, people will still buy and the government will still get their taxes. So on our side, my argument was, for banking, if we make these transactions expensive, we push them into informality. Now, informal, you can't even now get that population to be able to tax. So what we'll be doing is, even from the financial sectors, even the profits we make, we pay corporation tax, they'll drop. And then the transactions we get from excise will also drop. So in a way, we're about to have an understanding. So he promised that something will be done. So we look forward to actually being able to see the VAT getting off this ecosystem. And then lastly on that point, Fred has been able to explain that impact of VAT on our foreign currency. We have struggled for the last 1 year up to it was Valentine when the magic happened. So when we put, and now putting VAT on our foreign transactions, that will move the shilling up. That will have an effect on inflation, and worse still, even that VAT applies to the fees and the charges we apply on our loans. So even our loans will actually be able to move. And in the same conversation, I was having with government where I was saying we're having a debt. When the shilling moves by 1 shilling, the debt just escalates. So we just need to be able to manage this ecosystem, keep the rates where we are, and we'll be able to work within our financial inclusion journey.
A very quick follow-up, Raymond, there, if I may. Very briefly, now that you met the president, how does VAT on foreign exchange transactions work? I have tried to understand that proposition. Is it on spreads or what exactly?
Briefly, that conversation, both the president and the Finance and Planning Committee, they have no answer, including KRA. They have no answer as to, in fact, they asked us to be able to provide more input as to how it will apply. Because for banks there is no fee, there is no commission. We only do a spread. But they told us to give us feedback. We told them we are not even discussing that. We want VAT to be dropped. Yeah.
Shoot first, then aim later. That's what it sounds like. Phyllis, Kenya speaks a lot about the need for having export-led growth. In Finance Act 23, we saw the introduction of the Export and Investment Promotion Levy. How has that fared in your own assessment? And what measures do you think would actually catalyze that focus towards export-led growth?
Thank you very much for that, and for Deloitte for organizing this. Great to hear that some positive things are happening in manufacturing from EABL and for everyone else. But just speaking broadly about what I observe listening to the budget speech is that there's still that issue of tax predictability that the tax policy was trying to address. And we took a lot of time over the years trying to put in place a tax policy, but the challenge is whether we are actually going to have it implemented and implemented properly. My other observation on the budget is that our expenditures are growing more than our revenues. I think if you look at the percentages, the expenditures are growing by about 7.3% and the revenues by about 4.6%. So it means that fiscal consolidation still needs to happen. There's still going to be a lot of room for government to see how we bring down our expenditures. But the other thing for me now, leading to your question, is the issue of production. Because at the end of the day, to be able to grow the economy, it's not mainly about expanding the tax base, but really expanding our productive sectors. If we are able to expand our productive sectors, we can then have more income in the country and we'll be able to expand the tax base, not by burdening the same people. So that is really where the issue of investment comes in, and FDI into the country. I think I saw the export levy has been reduced or something from 17.5 and come lower. But the reality is, if we're going to attract FDI into the country or grow our exports, it's imperative that we look at what is happening globally and the global trends. I think some of the mega trends do indicate that there's room for global rebalancing as we look at countries reshoring and relooking at where they can invest. So there's a big opportunity for us to take advantage of that. The energy transition is a big trend also, with a lot of investments happening in sectors that support the transition in renewable energy and other things. The demographic dividend that exists also as a mega trend, because we are seeing aging populations in certain parts of the world, and we have a growing youth population. So we do have the dividend to enable us to be able to bring in export investments into our country. But the main thing, of course, for investors is that predictability. The reality of the cost of doing business. If investors are able to gauge from the economy that they are able to come and produce competitively in the country, that is something that I think will be able to attract investments. And I know that the government is looking at moving out of a lot of this tax expenditure and incentives, but what you see happening globally is performance-based incentives, where if governments are putting in place incentives, there are clear performances in terms of job creation, in terms of the benefit to the economy, and that is one direction that government can take. Look at how we can have more performance-based incentives in the country to enable us to grow our jobs. So that is a direction, if we're going to attract FDI or grow our exports, that we can look at as a country. Thanks.
I'm glad you preempted the discussion around fiscal consolidation, because now to come to Professor right next to me here. The government has been speaking about the need for fiscal consolidation. There is no secret, we're under an IMF program. And if you look at the budget for FY 24-25, based on the latest numbers we got yesterday, 3.99 trillion shillings. If you look at supplementary 2, it was at about 3.902, and Treasury argued to me, look, for many years, this is the most marginal increase. We have a deficit tight at initially 515 billion, now 597 billion. Professor, are we on the path to fiscal consolidation?
Thank you very much, Obok. Before I answer your question, let me make two comments. The first one is, even if there was no big signboard up here written JW Marriott, I would have known I'm in an American-based hotel, because all of you are freezing. I don't know why Americans like freezing their residences. Number two, let me give special thanks to two panelists here. One of them is Fred Omondi, and the other one is Rispa Genga. Both of them were my students, and nothing makes me happier than my students doing better than me. Asante sana. If I can go back to your question, a very increase. It surprised me. If you look at this budget, one of the things that comes out very clearly is that the government does not want to expand the expenditure. It wants to reduce the expenditure. I was very surprised to see that the deficit is reducing from 5.7% to about 3.3%. Those of you who have tried to reduce your weight, you know how hard it is to tighten your belt. So we are still waiting to see whether that is going to happen. And the best test to find out whether that is going to happen is to wait for supplementary budgets. So if there's no supplementary budget for the next 1 year, then I'll agree with you that there is some decrease in expenditure. But as long as that has not happened, we can only wait and see. Thank you.
And maybe let me stay with you, Prof. Treasury tells us Finance Bill 24, the measures proposed, are targeting an additional 346 billion shillings worth of tax revenue. Finance Act 23, as aggressive as it was, targeted 211 billion. Do you see 346 as being feasible?
Tax is always paid from the money that we make. So if we are going to meet that target, the economy should significantly grow. Now, if you look at the data that was presented here by another of my students, Gladys Makomi, the highest GDP growth rate that was indicated here is about 5.5%. We are yet to get Kibaki's dream of 10%. So if the economy is not going to grow fast enough so that we make more money and pay more taxes, then I don't see that happening. So I think it's ambitious to dream of having 308 billion extra tax or 211, but at the end of the day is a question, where is the money going to come from? And in my opinion, if the economy expands by making it very easy for us to do business, to invest, to expand what you have, to export and make our market bigger, if that happens, then even doubling to 600 or more is possible. But as long as the environment has not changed significantly, it is always good to dream. Thank you.
It's always good to dream. Interesting there. So I want to give one round of questions, and I invite questions from the floor, so be ready with your questions, please. Fred, as you were making your presentation, one of the things which I was surprised was not captured, especially when it comes to, because Finance Bill 24, let's be honest, is heavily leaning on indirect taxes, is the proposal around the VAT apportionment formula, Section 17 of the VAT Act. Fred, how do you see that playing out, especially in an environment where we have now transitioned to auto-population of VAT, courtesy of e-teams, which has had outage for like a week now?
Yeah, so VAT apportionment, quite controversial even before the latest complication, you know. So VAT apportionment arises when you are supplying both what we call taxable and non-taxable supplies. So in a sense, it's mixed, and then you have to decide which input can you claim. If you have to apportion, then it means you apportion and you don't claim those that are attributable to the exempt supplies. Now, the change is such that before, if you are supplying at least 90% taxable goods, then you didn't have to apportion. But now they're saying regardless of the threshold, you need to apportion. So it makes work very difficult. If, for example, 5% of your supplies are exempt, then you have to determine what input VAT to apportion to I mean, in terms of the exempt supplies. And with e-teams, remember with e-teams, then the data in your VAT return is auto-populated, at least if e-team was working the way it's supposed to work. I'm told this month it's not been transmitting, so I don't know whether the data that they have is actually accurate. But that means that it requires a lot of manual intervention, you know, to be able to compute these adjustments, and that only makes compliance much more difficult. I mean, we have retail traders here who have millions of transactions. We have, if you bring in the financial services, you know, they generate their revenue every second, if I'm not wrong, you know. They post charges to your statements or to your ledgers, you know, every other time. So if you have to apportion the VAT attributable to all these services, you can imagine, you know, the nightmare that will be. So overall, my comment is that I think we move too fast before we get prepared for what we want to implement. So some of the ideas could be noble, like e-teams, or some of the other compliance measures that we are trying to introduce. But we tend to move too fast before we lay in place the necessary framework to be able to achieve what we desire. So maybe it calls for a bit of, engagement with the businesses, especially, to understand how their systems work, what is practical, what is not practical, and then you can design a tax policy that is friendly to the taxpayers. And I guess this morning we were having a conversation around how friendly is our revenue to the taxpayers. So we need to inculcate that so that tax is not seen as something that must be, yes, we know tax is a burden, we know tax is painful, but we say in terms of the art of taxation, you shouldn't make it too painful that you encourage people to evade, You should make it a little friendly so that actually people feel appreciated and feel the need to comply on their own volition. But with the kind of rush that we are in to make some of these changes, it makes it very painful for taxpayers. Even those with the best intentions find it very difficult to comply.
Thank you for that, Fred. Rispa, let's go back to Section 36 and the remittance of excise collections within 24 hours. Is 5 working days the sweet spot? I raised this matter with the National Assembly Finance and Planning Committee, and I was told, look, GOK has to manage its cash flows, one way or another.
Yeah, I think it's not. It's not going to solve anything. Quite frankly, we see the intent is positive in trying to do something. But first, the error is in even how they've crafted it. Because they say, once you remove the goods from the store, then 5 days from there. So you might get a benefit from July 1st to 5th, and then after that, it's every day anyway. So really nothing has changed as far as is concerned. Even more important is that we did a comparison, how does this work elsewhere? Because it's important to recognize that in manufacturing, unlike financial services where you automatically debit the fees, we don't automatically get the cash on that day. We sell, we get the money 30 days later, and then we close our ledgers and we know where everything stands, we reconcile all your stock, and then you can file your tax returns. Now this introduces unnecessary complexity, it introduces working capital gaps, and it's extremely challenging. And we looked at other markets, and Tanzania gives you 30 days, Uganda gives you 15 days, Nigeria gives you 21 days, Ghana gives you 21 days. So I think it's not for lack of understanding that manufacturing is actually a process of production that involves quite a complex thing for you to even cost your goods, calculate them, finish your sales and your collection. I think it just demonstrates a lack of understanding, and it really makes it difficult for manufacturing, where we've had extreme difficulty in because of some of these policies. So I recognize the gesture in the right direction, but actually it doesn't move the dial at all. We are enriching banks in the process.
And on that point, let me now come to Raymond. So Raymond, one of the contentious issues in Finance Bill 24 has been the proposal to amend the Data Protection Act, exempting KRA from its constraints because of accessing data. And what would this mean for financial institutions? Because one, we appreciate there are already common reporting standards, there's some level of disclosure you're obliged to make to the Revenue Authority anyway.
Now, this is one of the very difficult proposals to actually be able to implement. And I think Kenyans have not appreciated it more as to what that means when KRA integrates with banks and the telcos. Because technically, KRA is becoming another bank. So all the records that your bank or the telco has, KRA will have access to. So where you slept and paid a bill using a card or mobile transaction, where you had lunch, where you flew to, KRA has all those details. What you bought and you used a card, or now we've linked our accounts to our mobile phones. So KRA will have all that narration, and it's real time. That's the proposal. So what we've been asking, and what we feel is KRA doesn't have the regulatory limits and thresholds as compared to banks and telcos as far as data privacy is concerned, and how we keep safe your information. Because for a bank, we'll die with the information we have. We don't disclose as to where you took breakfast and paid, even if we knew how many people you are or who you are with, or who paid your bill, where you are. We don't disclose that. But all that is now being opened up to KRA through this, because all along we've worked very, very well with the Revenue Authority and even investigative authorities. What they do is just, they need to get a court order, or the tax procedures even allow KRA to be able to ask for specific information, then we can be able to give out. But what they want is open the whole door, real time. As the bank keeps the information, then KRA also on the other side, it's having the information here. So we feel KRA has no regulatory framework to actually be able to keep our information secret. And then again, we know it quite well, in that at some point, the political of the day may actually be able to infiltrate into KRA to some extent that even your own business can actually be able to be affected by what KRA holds. And yet, in effect, it's not true. And some of the claims that KRA come around with, when you interrogate it, you actually find out that it was just a witch hunt and there was no basis. So that's the concern we have, and it's a concern that I think Kenyans haven't been able to get it very clearly as to what this integration means.
I actually think Kenyans have really appreciated what that means, because part of the feedback I've immensely received, apart from the motor vehicle tax, is actually on that one. Phyllis, the headache of tax expenditure is with us. If you look at the latest tax expenditure report, it's about 396 billion shillings. Here we are looking at how do we address creating an environment which attracts investment versus the tax expenditure trade-off.
Thanks for that. I think listening to the conversation and the good professor, one of the things we are saying is that we are having an economic growth problem, because the numbers show that we are growing at about 5%, 5.6%, but the reality for us to be where we need to be growing at about 10% per annum as a country. So if you look at some of the things that have triggered economic growth globally, I know we like to give examples of countries that have succeeded, but I'll just share a few of the things when you look at literature and actually experience that are able to grow economies. One of them is a strong political coalition for economic transformation. There's need for that strong political leadership and the leadership commitment, because of course tough choices have to be made if you're going to grow an economy, and indicatively some of them are being made now, but it doesn't mean that all of them are the right choices. So the other thing then is a clear and inspiring vision and strategy. So that clarity of where we want to go. Vision 2030 was providing that clarity and continues to, but can we really just ensure that as a country, we are very clear on what the vision is and that we are continuing to galvanize people around it? Because when you hear the whispers sometimes from investors and some of the citizens, that galvanization needs to happen even more. The third thing for me is the effective coordination structures and the delivery mechanisms, because it's one thing to have a vision, but the reality of getting it done is something else. And what happens is that can happen through the pockets of effectiveness that are created in governments. If you look at Korea, for example, they had the planning board that ensured that they stayed true to the vision, that they were following through on the commitments they had made, and those are some of the things you see that are actually critical in growing an economy. And then the fit for purpose policy instrument, that now leads to the right policies and how those policies are designed. And listening to the panelists who are experts in their sectors, sometimes policy design can affect how effective a government is in driving economic growth. So that's an area I think that is critical. And of course, a supportive business environment. So for South Korea, just to give a high-level example, under the leadership of President Park, they did see their export-oriented growth grow quite significantly and moving them from an agrarian economy to a big leader in high-tech industries and others. And some of the practical things they had is that strong political coalition under the leader. And then they were very clear that what they were looking for was export-oriented growth. And they had an effective coordination mechanism under the Economic Planning Board, which ensured that they stuck to the objectives. Vietnam is also similar, where they had that leadership commitment, but also ensuring that they had very good coordination and pockets of effectiveness within government. Mauritius went through the same also with its transformation. So I think having some of those things, it might not be the full list, but those are some of the few things at least that can ensure that the policy direction is really consistent and driving a very clear vision for a country to grow its economy.
Thank you, Phyllis. Professor, before I open the floor to the audience here, there's a Kenyan who wrote to me and told me, at least in FY 24-25, we don't have the Eurobond maturity hanging over our necks. And I hold the unpopular view that actually our bigger headache is domestic debt, because if you look at the consolidated fund services, the bulk of it is domestic debt service. How do you see the landscape going ahead in terms of debt?
Good question, but let me respond to my neighbor here, because you happen to be sitting next to me. You're saying that KRA should not be exempted from Data Protection Act. And if they are given that exemption, also as a professor, I should also ask to get that exemption, so that if any of you annoys me, I can disclose your grades in public. So that if Mariah annoys me, I can tell you what grade I gave her. I think if I look at the budget, it's very clear that there will be a deficit. And there are two areas where I saw money coming from: domestic borrowing and foreign borrowing, or offshore. And more money seems to be coming from offshore borrowing. So clearly, the question you asked me earlier was about how much extra tax we are going to raise. And indications are that we are not going to get our target. If we don't get our tax target, the alternative would be to borrow. So in the next 1 or 2 years, my observation is we are going to borrow more. And it seems we are going to borrow more from external market because naturally the rates are much lower. And personally, I've never had a problem with debt. I've never had a problem with borrowing money. It's a question of what we do with it. So maybe one way to make Kenyans happy is to borrow more at reasonable rates so that you pay less taxes. If that can be done, you get a balance between borrowing and tax, I'll be a very happy man. But from where I sit, I still see some borrowing taking place in the next 1 year or so. I don't see it stopping.
But Prof, how do we borrow more at reasonable rates? We also saw the coupon of the Eurobond we floated in Feb, a steep 10% on the dollar. It's quite pricey. The global markets have literally shut.
It is very easy to borrow at a good rate. All of you here have your credit rating, and that is used to determine whether you are going to pay higher or not. So to confirm what Phyllis has said, if we improved our national image so that Kenya is seen as a very stable country, then there's no reason why we cannot borrow at a lower rate. Some of you in this group are wearing Italian shoes. I'm sure there are better shoes elsewhere. Some of you drive Japanese cars. There are better cars elsewhere. Some of you watch American movies. There are better movies elsewhere. But over time, the image of those countries and their products has been improved. So if we can improve our image, national image, people see as a country where your investment will be protected, where there's rule of law, where there is peace, where there's prosperity, I'm sure our rates will go down. And there's no reason why we cannot borrow at a better rate than other countries. So one of the ways to do that is to improve our image. We become a country that is going to attract more tourists, more investors, and a country that everybody will be proud of. Thank you.
Thank you, Prof. Prof has talked about some of us are wearing Italian shoes, Japanese cars. American movies, and some of us are wearing Swiss watches, and there are no better watches anywhere else.
My shoe is from around.
I want to invite questions from the floor, and the drill is very simple. Just shoot up your hand, introduce yourself, and to whom you're directing the question. I can see a hand at the back. That's Jimmy. Let's just have the roving mic get to him.
All right, good morning, everyone. Jimmy Mbogo from Citizen TV. And I have a question for Fred. In your presentation, one of the things that you talked about is that increase from 15% of GDP in terms of taxation to about 20% by the end of this term. And I just want to know, do we have scope to raise that one extra trillion shilling? Because from what we are hearing from Kenyans, the big question is, itoke wapi? All right, and another question for Raymond. There's a lot of conversation around what is happening in the banking sector. And one of the proposals that came out yesterday is to increase the capital, the minimum capital for banks from about 1 billion to about 10 billion. Now, that coupled with everything else that is happening in this finance bill, where does that leave the banking sector?
Thanks. Two questions there from Jimmy. One is on the tax to GDP ratio and whether we have a runway to actually mobilize that extra trillion bulb. And the second one is on the proposal around core capital requirements, 10x up. I should clarify, the CS said progressively, so it's not a bullet requirement. But anyway, any other question before we start responding? Okay, let me allow Fred to respond, then Raymond.
Yeah, good question there. So it's a qualified yes. So there is definitely scope to grow the tax revenue. The issue is how, you know. So, and we all like talking about the national pie when we are talking about other things. But tax is also, you know, you can look at it from that perspective, that is a share of the pie. So you could either get a bigger share by squeezing someone else and taking, you know, his share, or by creating a bigger pie so that everybody gets, everybody is happy, if you see what I mean. So what is currently happening is when we increase tax rates and, you know, eliminate, you know, incentives and, you know, all these so-called expenditures, what we are doing is we are taking more from the existing taxpayers. So if you are paying tax of 20, 30%, now you're going to be paying 40% if you add the levies and all that. So we are taking more from you and diminishing your net or disposable income. But if we wanted to generate more, we could do what all the panelists here have mentioned, which is the other alternative, is to grow the base or the pie by encouraging more investment, more economic activities, attracting, you know, more entities to set up here, you know, building or creating rather quality jobs, and then from that we will be able to net more taxes without necessarily having to increase rates. Of course, the other option is also enhancing compliance. The challenge we have is we probably don't want to do the hard work of targeting the, what we call the hard to tax sector. I don't want to put the informal sector in a box because some of them comply. So let me use the hard to tax, you know, sector or individuals. So we need to find a way to effectively bring them in, make it simpler for them to pay whatever little it is that they have to pay, as opposed to the current approach where we tend to go back to the same corporates, the same taxpayers who are mostly the employees on payroll, because that just makes it much more painful and increases the tax burden, and then encourages evasion, reduces consumption, encourages what you've had, mattress banking or whatever we call it, you know, or encourages companies to relocate to other countries where it's cheaper for them to operate. So that is counterproductive. So I would rather a strategy where we create more opportunities, we build more industries, we create more jobs, we encourage, you know, a lot of the youth to be more innovative, to engage in more economic activity, And through that, there'll be more tax generated in the process.
Thank you, Fred. Speaking to the need to widen the tax base, maybe a quick rider there, Fred, and very briefly is, sometimes I find Kenyans conflicted about this issue of widening the tax base. So when Finance Act 23 introduces e-teams, doctors don't want it, they want exemptions. A couple of other professions don't want it. When MTRS says they will introduce 5% withholding tax as a final tax for farm produce, farmers don't want it, KRA officials are chased away. How exactly do we imagine we'll expand this base? Sorry for that, Fred.
No, so I think I'd addressed it earlier, actually, and I said for me the issue is in how these measures are implemented. The measures themselves may not be a problem, but it's in how they're implemented. And to give you an example, some countries, I have one in mind, France, for example, is introducing something similar to e-teams. They're giving their taxpayers 2 years to prepare and get on board. We gave our people 2-3 months, and in fact, the Revenue Authority itself was not ready. So the system is not working properly. We are not piloting and testing it with what the businesses are doing or the technologies that they have to make it easier for them to adopt it. So the challenge is not with the intention, the challenge is with the execution. And if the execution is poor, then we have all those challenges. And that explains, if you just limit it to VAT, that explains why we've moved from ETR to, what was the second one? And now to e-teams. Within a short period, we've changed to 3 systems. None of them was wrong, but we implemented them maybe in the wrong way, and then it didn't achieve the desired result, and now we are back to the drawing board. Who knows, after 1 year, there'll be another system to replace e-teams, and that talks to the unpredictability or in the instability of the tax system. So to me, it's about simplicity. Technology in itself may not be a solution if you don't bring it down to the level of the person that you are targeting. Maybe RISPA and DABL may be able to cope with the technology. I don't know if they're coping, But imagine the Mama Mboga and the Boda Boda, if those are the ones we are targeting. Do they know how to download that software and install it in their smartphones if they have one in the first place?
Thanks, Fred. Raymond, there was a question for you as well.
Yes, as of this morning, we only have 15 banks. If we had to draw the line and say 10 billion as a minimum capital, we only have 15 banks which qualify. But thanks, Julian has indicated, the Cabinet Secretary said it's progressive. So we'll be able to engage, discuss, and even just get to understand the thinking behind the 10X, because it's very, very ambitious, and living within the economy, who is having the cash to just be able to do 10X, moving from 1 billion to 10 billion. And remember the last movement we did, that was in 2012, I believe. That's when we moved to the 1 billion, and again it was progressive. Again, this market, we have 38 banks, and they serve different segments within our ecosystem. If you want to move everybody to, let's say, tier 1, there's a whole population you'll actually be able to live out, because when you acquire tier 1 status in life, there's that aspect of you now look at your book, be able to assess as to who I can be able to stretch my hand to and who I can actually be able to live on the side, because banks are private businesses just also living within this difficult economic environment. So you will not dictate to a bank as to you must lend to this particular customer. So that's a challenge. If we, by a stroke of a pen, we get to move the 10 without having to understand how the ecosystem is working, that creates a challenge. And then that also brings us to that question of government being able to engage the private sector and businesses. And I look forward to the 2025 bill, in that government ought to come to us in November, October, not to ask for our proposals, but to come to us, indicating to us the areas they are focusing on, so that we can have a real discussion as to, and very meaningful, as to what goes within our ecosystem and what can be able to help the government achieve their revenue targets. Unlike before, where we just give our comments, then now they surprise us come May with a finance bill that is speaking direct opposite of our contributions.
I see. So his thoughts there on the recapitalization, it's progressive, and we have seen the same being done in Nigeria. We've seen it in Ghana as well. So I guess we are catching the momentum around the consolidation of the banking sector. Any other question before I get to the closing leg with my panelists? Yes, there's a hand here. Just introduce yourself and shoot your question.
Okay, my name is Lottie. I hope you can hear me. My question is to probably Fred and RISPA, because they interact with the taxes on a daily basis, either from a production or Fred from an advisory perspective.
Please just raise your mic a bit.
Okay, so there's a lot of talk of, you've talked about expanding the tax base, consumers are complaining, and everyone has been saying that this finance bill is almost picking from the medium-term revenue policy and the national tax policy. So from a predictability perspective, where do you see us, and also to take the remarks of the minister who doesn't want the finance bill to be amended, so presuming it will pass as it is. So as taxpayers, for us to think of from a predictability perspective, when you look at the medium-term revenue strategy for the government, where do you see us going? Are we going to see a surcharge tax? Are they going to increase the VAT rates? Because I feel like we are left to ourselves to determine what is predictable to us and then make business plans from there.
Question there around predictability, focusing on the MTRS. Thankfully, MTRS has an implementation matrix. There's a hand here from a gentleman. Let's take that and then we can respond.
Thank you very much. My name is Peter Mwangi. Perhaps a suggestion to the panelists in their closing remarks to perhaps give us some thought leadership around how can we help the government in terms of growing the GDP, particularly private-led growth. This is because it is clear, projected that the government expenditure will continue to grow, the debt will continue to grow. 2 days ago, Powell mentioned that the Fed rates will remain high for longer. So even our borrowing out there offshore will continue to be higher. So in an effort to grow the revenue, I don't think increased rates is an answer. So how do we change the leadership or the thought process for government to think differently? Because moving from 15 to 20% is ambitious, highly unlikely. So if you project into the future, we are looking at a perfect storm. To avoid this perfect storm, the answer is growth of the GDP. So how do we help the government get there? Thank you.
Thank you. How do we support the government in GDP growth? Okay, we'll respond to those. So the first question was on MTRS and predictability. RISPA, you want to go for it?
Thanks, Lottie. I think the MTRS has a few pillars. Around one, it intends to increase disposable income. There are some measures which have, but I think they give with one hand and take with the other. Widening the tax base, I think as Kenyans, it's our obligation to pay tax. For the services we get, we should pay tax. However, I think there's a lot around how that is conducted, how that is used, and also how it is made simpler for us. So I think the first place is we get a voice to speak when we also pay our way. And I would also challenge the policymakers, don't exempt yourselves. It makes it difficult for everybody else to see why they should contribute when you're not contributing. So I think each and every one of us must contribute. The other element is around improving compliance. I think when you see some of the technology, even though sometimes it's hit and miss, is to see that compliance is in place, and finally to mobilize revenue. So I think there are steps towards starting to think in that direction. I do think it's give and take, which makes us as industry players a bit challenged in terms of policy predictability. I do think it's a longer journey to achieve some of these things. But I also think that sometimes we're obsessed with the ratios. I'm a lover of mathematics, but sometimes the ratios go mad. You look at the spend and you say it's nominal increase of 7%. What about the base? Like, what have we spent that money on the amount that we've put out there to start with? Shouldn't we even be questioning the base before saying it's only growing 7%? And we don't ask those questions. When you think about the tax to GDP, we are obsessed about the ratio. Why are we obsessed about the ratio? You can get the ratio on a much smaller GDP. Is that what we're trying to do? Yeah? Why can't we focus on the outcomes that we're trying to get as a country and then deploy the methods that will actually take us there? So I think there's a lot we can do. I'm encouraged by the level of awareness by Kenyans around this finance bill. If there's nothing else it's done, it's made us wake up and contribute. And finally, I think for me is to say, when I think about the elements that the theme is around, you cannot bring the bottom up by breaking down the middle. You've got to build all the way. And so some of this looks like, and we feel it in our business, that the middle is folding quickly to the bottom and the bottom is falling off. You cannot build by breaking down the middle.
Fred, do you want to add something to it?
Yeah, so Rispa said it, but yeah, in terms of predictability or stability, like you said, it will be difficult to be optimistic given the kind of, how do I put it, the kind of pressure that the government is portraying, I don't know how real it is, but, the pressure that they're portraying, that because of our debt situation, because of what they want to achieve, which, like we said, we need to be clear on what we really want to achieve. They're determined to then see taxation really grow significantly, and they've said several numbers. I think there was a time they even mentioned doubling the tax collection, which is unrealistic. So what you should expect, if you ask me, is greater aggressiveness and enforcement by the Revenue Authority. Unfortunately, because of our targeting the easy to target sectors, financial services are going to continue to be a focus. Maybe the other ones like fuel, alcoholic products, the typical or the usual suspects are still going to continue to be on the spotlight if we are not going to be innovative around our tax policy. So I guess the question is, how innovative can we be to see other ways in which we can bring other taxpayers into the net? And that ties into his question around what should we recommend going forward. The panelists have talked about it, how to grow this economy. There are some good things that are happening, but they are not happening consistently and at a large scale. So you've seen, the government promoting, for example, our country to the US, for example, and attracting new investors. We hope they actually come in and set up, because sometimes what happens, there's a lot of promises and then there's a breakdown in the follow-through. So you hear there'll be a big data center being set up here, and maybe sometimes it falls through the cracks. So if we were to do more of those, Kenya has potential actually to export a lot of labor. And nowadays, because of technology, we don't have to physically relocate our labor. We can actually utilize them here to supply the demand that is existing, in the global marketplace. That can create income within the economy, generate jobs, of course, and encourage, more people to engage in economic activity, and that will lead to more tax generation. So there's quite a lot that can be done, but it takes consistency. I mean, Phyllis sort of summarized it. It takes a lot of consistency. It takes being focused on on what you want to achieve. It takes a bit of patience, because sometimes what we see with investors, because we interact with them, when they want to put in their capital, the government is not patient. And this happened with the oil and gas sector, for example. There was a lot of prospecting that was needed, but we started taxing them at the prospecting stage. And a lot of those investors simply folded up and left. In fact, now they're handing back the oil fields to us and saying, you take it back, we don't need it, So you need a lot of patience, a lot of consistency, a lot of right tone, from all government institutions, not just the executive, but even other regulatory agencies sometimes. I was reading a story where somebody was saying they'd applied for a license to set up a factory and it had taken a year, So most investors will not wait for that long. So it's around the whole investment environment, around job creation, around our image, as the professor said, that will be able to attract more and generate more taxation.
Thank you, Fred, for that. I want to invite my panelists to give their closing thoughts, and starting with Prof here, responding to that question of how can we support the government in the efforts to grow the economy.
Thank you very much. I'll be very brief, but let me start by sharing something that I experienced yesterday. I was around Grove Roundabout at around 2:30 p.m. yesterday. Some of you either own matatus or you take matatus. And something surprised me. I was waiting for somebody there. All the matatus that passed there were not playing reggae music or loud music. All of them were on budget. You can imagine matatus tuning to the budget, reading of the budget. And I thought that was very good news. If you remember what happened to our campaigns in 2022, it was all about the economy. We have all become homo economicus. So I think the fact that even the lowest people in the society are looking at the economy is good news. Because only by understanding the economic issues that we can turn it around. Number two, one way to make people pay more taxes is to show them where their taxes go. And I have a very good example I came across in Kentucky. I'm not boasting, I'm just informing you. I was just driving along the road, and I saw a signboard that I've never forgotten. If you see a pothole, call this number. And we need such signboards in Kenya. Because once we see where our taxes are going, you don't need to worry about e-teams and the rest. We shall pay the taxes. Those are technological issues. Number three, how do we expand the GDP to respond to my friend there? It's very simple. Focus on the taxpayer, not the tax. And I think that's a mistake we make in this country. We focus too much on the tax and not the taxpayer. I don't know whether you have any MP here or member of parliament. If you listen to the CS reading the speech yesterday, he kept on referring to Mr. Speaker, Mr. Speaker. I think we should change the starting order so that from next year, he says Mr. Taxpayer. Because that's the person who really matters if the economy has to grow. The economy is about the people, through people, for the people. That's one way to expand the economy. Just focus on the people who generate the economy, who generate the economic activities, who work hard from the rising of the sun to the setting of the sun. My final remarks is I'm hoping that the next time we sit here, we shall not be talking about the budget deficit, but the budget surplus. And I hope that is going to happen in my lifetime. Because I believe Kenya is a country of possibilities. Look at what we have done with M-Pesa. Look at what we have done with Marathon. If we can focus the same energy on economic issues, there's no reason why we cannot transform this country in the way we want and in our lifetime. Thank you.
Thank you, Professor, and I certainly also hope that we'll be able to see a budget surplus. Going back to I think it was the first budget of David Mwiraria, who was the finance minister under Mwai Kibaki. Raymond, your closing thoughts.
Now, I've had this conversation with both the MPs and even the president, and actually for the president, we argued quite at length on the aspect that the data we have from banks, and for the last 5 years, we've been doing what we call total tax contribution. So we compute all the taxes that we collect, both direct and indirect, and be able to pay to government. So last year, excise duty was increased from 15 to 20. Was reduced from 20 to 15. And then our transactions within banks increased by 26%. And we're just measuring for a period of 6 months, from 1st of July to 31st of December. And then also the revenue realized moving in 2022 from 40 billion to 45 billion. So my argument was, if we reduce the tax rates, there is actually more of activities. People will actually be able to do more transactions. People will be willing to transact more, even without feeling that there is actually a charge. However, for the decision makers, they have a different mindset of looking at, let's increase the rates, we'll actually be able to get more, and that doesn't work. So it's a conversation that we still need to push ahead with our decision makers to be able to understand our ecosystems. Because this 26% increase, it was actually for the very first time, because all along, our transactions move by single digits. But for the first time, it moved by 26%, just by being able to drop the rate that we are charging. So we look forward to this conversation where we have to be able to reduce taxes and then be able to bring in more Kenyans. And then also, the other good message I had from government, both the National Treasury and the President, was that they're not looking at increasing VAT. In fact, the thinking is VAT needs to come down. So that's a good sign that let's focus on trying to bring the rates down. We bring in more people, including the exemptions that are there. When they drop the exemptions, can they bring the VAT down? Then now we get everybody within the ecosystem as we increase production. Yeah, thank you.
That's quite spot on. In fact, the MTRS envisions, we were supposed to see via Finance Bill 24, VAT going from 16 to 15, but we haven't seen that. Phyllis, your closing thoughts.
Thanks everyone. I think just echoing the fact that we need to strengthen that social contract by having more accountability of where the tax revenues go to. That way, Kenyans are galvanized towards a common vision and want to see the economy grow. The other one for me is, how do we grow the economy? There's a big opportunity for us to have export-oriented growth. Last year, for the first time, our exports crossed the 1 trillion mark. It's debatable whether it is because of the weakening of the Kenya shilling, but either way, they crossed the 1 trillion mark. We saw exports grow by 15.4%, but the reality is a lot of those are still in raw agricultural products, with tea being the highest, horticulture, our textile and apparel sector, amongst others. So there's a big opportunity there for growth of certain value chains that can lead to higher exports. The other place we can grow is our import substitution. We are bringing in about 2.6 trillion of imports. There's a huge opportunity to grow there. So I think if we see growth in the real economy, in productive sectors like manufacturing, tourism, banking, the digital economy, there's really a huge opportunity, as we're saying, and as Prof has said, for Kenya to easily double their economy. The opportunity is out there. Investors are looking for markets to get into. We are low-lying fruit if only we have the right investment environment, and also for our local investors, because investment can come significantly from local investors who would be encouraged to expand their investments if they get the right signaling from government. So yeah, watching how the year goes, and hopefully we can put in place measures that galvanize us towards growing the economy. Thanks.
Thanks, Phyllis. Export-led growth there. Rispa, your closing thoughts.
Yeah, let me just pick up from Phyllis and just reflecting back on what the minister was trying to achieve in terms of, one, the bottom-up transformation agenda to start with. That can't be achieved with handouts to start with. It can only be achieved by economic growth. Now, Phyllis talks about exports. We can only be an exporter if we are competitive as a market. We are not operating in a vacuum. If our policies are so out of work that it is more beneficial for an investor to go somewhere else, then we've lost the plot. So we really need to think about that in context, that for us to grow this economy, the policies must support industry, and they must be competitive against our neighbors and other peers. we're sort of like the runner who starts the race really fast. And we've got all the things lined up for us. We've got a great, well-educated population. We've got great weather. We've got a lot of potential as a country. But if we stop running and go to the forest to look for some random mangoes, everybody else is going to run fast, catch up with us, and go ahead. And that's where the investments will move. If I think about manufacturing, the number of companies that have since gone elsewhere should tell us something. It should tell us that we really need to think about our policy environment and how it encourages us to keep running, build this economy so that we can actually bring that bottom up rather than crush the middle back down to the bottom. The second piece is around fiscal consolidation. Again, we need an honest conversation with ourselves. Growing off a bad base is not good enough. We need to go back and ask ourselves, where did this money go? Is this really the right base? How do we rebase the spend rather than say, it's only 7%, so it's fine. And also, it's symbolically wrong to grow your expenditure faster than your income. Every good business knows that you should never do that. So I think symbolically, we should just stop doing that. And then the last piece on his agenda, which almost seemed like an afterthought, was a piece around climate change. We're big on that. We are passionate about it. I think some of the things went against it. Introducing tax on EVs, which is something we need from a climate change perspective. So I think we also need to introspect quite deeply. I know there are actions to think more deeply around that, but if we're going to be serious about being on the forefront of climate change and sustainability, we've got to put our money and our tax policy behind that.
Thank you, Rispa. Fred, as you give us your closing thoughts, you spoke about the need for innovative tax policy which targets the hard-to-tax sectors. This country has had an adventure with presumptive tax for that very purpose, including latest via Finance Act 28. It didn't seem to work. What are your thoughts? Because the MTRS envisions it coming back.
Yeah, so maybe not in the same form, because if we tried it and it didn't work, and that was many years ago, so things have probably changed. So we need to look at the convenient points for the taxpayers. So for example, if it's the traders, is it at the point when, you know, they're renewing their licenses? You know, should we consolidate that with maybe the taxes that they pay? You know, if it's for, you know, guys in the digital space, is it the withholding tax that we are talking about, or is it something else that we need to introduce that is convenient for them? And sometimes starting small is important, because sometimes I think we want to go big, but it doesn't work, you know. So sometimes it could be as simple as, there was a time the KRA set up an office in Isili, and I think after a few months they closed it, you know, because maybe they were expecting billions in 1 month and they didn't get the billions, so they gave up, you know. But if you don't set up the infrastructure and support these taxpayers to really even get to understand how they file their returns, for example, what they need to pay, and, you know, then you'll never achieve it. You'll keep coming back to the large taxpayer, so to say. So we need to have that patience to be able to build, you know, our taxpayer base. I think that's definitely required. You know, we don't have to, like we said, and people have shared the experiences here around, sometimes when the rates are lower, then people spend more, and we've had a good case last year, for example, with fuel. When the prices went up, actually the taxes came down. So again, just learning the lesson that it's not all about having the high tax rates, you know. And I like giving the example of countries like the UAE. They operated almost like tax-free countries, but it doesn't mean the government did not have revenue. They actually focused on attracting tourists, and when you went there, you paid a lot of levies to the hotels, you paid, you know, your airport charges and all that, and that generated a lot of revenue there. And then when they had a captive, you know, base in terms of foreigners who've settled in that country, we have a lot of companies who've established regional head offices there. Now they've started introducing taxes slowly, you know, so they now have VAT, they have corporate tax, but it's still at a very low rate, so it's low enough that the ones who are there don't feel the need to move. So that's the kind of creativity that we are talking about. Don't go for the kill immediately. Try and make it like you are wooing the taxpayer, and then when they get in, they get stuck. They have nowhere to go, you know. So maybe they should talk to me a bit more. I'll give them more ideas, you know. But overall, I think in terms of concluding comments, I'm happy to see the engagement that taxpayers are having with the policymakers, although some of it may be painful to watch, where our policymakers are not able to explain what they've proposed, but it now calls them to really think through what they are doing. Unlike before, when it was taken for granted that, you know, you'll have the bill and, you know, it goes the way that you want it to go. But now they're able to think that, you know, taxpayers will ask us, what are we seeking to achieve? What are we doing with the tax that we are collecting? You know, why are we flying private jets? Who paid for it? You know, all those questions are coming up. And they're important questions. They may appear, you are bothering them, but, you know, now it's forcing them to think. And it's the same thinking that will now force them to be more creative around how we grow our economy, how we collect more taxes, how we, you know, create inclusive growth, you know, that benefits all people across, you know, the population. So I think I'd like to encourage that. I'd like to see more engagement. I'd like to see more cooperation between taxpayers, the business community, and the policymakers, as opposed to, you know, this is our document as policymakers. You give us your suggestions, and then we take what we like and we leave the rest. Ideally, we should be able to craft some of these policies through a collaborative arrangement, and that will yield better results than what is forced down, you know, the throat of taxpayers. Thank you.
Thank you, Fred, and thank you to Rispa and Phyllis and Raymond and Prof. Let's appreciate this panel for the insights shared on budgets 24-25 as well as Finance Bill 2024. I shall usher them back to their seats. The step is behind here, so just be very careful as I hand the program back to Ivy. Please.
Another round of applause for our panelists. So I think the main things I have personally gathered from the session was 1, sustainability, and 2, transparency. Okay, no one is opposed to paying taxes here, I think. But how are these taxes going to be used? Yeah, we don't mind paying more taxes, but tuingize pole pole, not just all at a go. I was paying 200 bob to get my hair done. Now suddenly I'm paying 1,000 bob because people can't import hair products and braids and weaves, all right? So sustainability and transparency, for me anyway. Whatever your takeaways from the panel session has been today, please don't let the conversation die down, all right? I think we're at a very interesting point in time where everyone is interested. Everyone is looking towards this finance bill. Everyone is following the budget. We can't afford to let that momentum die. So even as you leave here today, please don't let the conversation die. Keep stroking the fire, keep stroking the fire. Something has to give, okay? Something has to give. All right, so I will end my sermon there. And I would like to invite Anne Mariah, our delightful Deloitte CEO, to give her closing remarks.
Thanks. A warm round of applause for Ivy, great MC. So a few takeaways from me on this. First of all, after Rispa told us where Chrome is going to get to, one of my colleagues whose name I won't mention has said the thing to do is to drink beer, right? So we now know where to go. The other thing is, in keeping with what Prof said about improving our image, we all need to stay on the good side of Professor before he reveals our grades. And then maybe we might even solve for X. Does anyone know what X in Iraqi is for? We need to solve for X, right? But also then we got some really good insights from the whole panel. RISPA told us to focus on the outcomes. Percentages mean nothing, and ratios if you're not looking at the underlying number. And so it's important that we're properly focusing on those outcomes. Phyllis, in a sense, told us we need to have a method to our madness. Okay, if there's somewhere we want to go, let's have a plan, let's follow it, and let's do that, then that will get us somewhere. Prof also told us to make sure we focus on the taxpayer. Raymond highlighted the importance of, first of all, not letting KRA see your activities, but also understanding the effects of all the taxes all around, not just on one side. And then, of course, Fred told us very, very many things. First of all, I can't imagine how many cars I've bought for the government, and I'm still dealing with that. But then also to make sure that we get the tone right on the things we do, and then understand and have all the parts of the governments talking to each other. So thank you all very much for our attention. I think, like I said earlier, we're all stakeholders in Kenya Inc. Let's continue engaging so that I guess we build this country to get that double GDP that the Prof told us about. And of course, a big round of applause to Julians, who very ably moderated that panel and kept us all interested. Thank you all very much for coming, and let's continue supporting this wonderful country that we live in.